Banks don't want you to know they've changed the rules, making it harder than ever to qualify for business funding. I know you've heard it before. Your business hasn't been around long enough, your usage is too low, or some vague policy is standing in your way. It's frustrating, it's confusing, and downright discouraging when you're trying to grow your business but keep hitting roadblocks banks won't even explain to you. So coming up, you'll see how some banks are putting a hold on your business assets, which then stops you from getting more funding. Plus, there are two secret credit bureaus that banks like Bank of America are quietly checking behind the scenes before they decide to approve you. This is stuff they don't tell you, but it's making a huge difference in who gets funding and who doesn't. Now, what if you launched your dream business, pouring your heart and your savings into making it a reality? You approach the bank for a business credit line, ready to take the next step, only to hear, sorry, we only fund businesses that have been operating for 2 years or more. This is becoming more of the norm. Banks like KeyBank and Citizens Banks, once known for being accessible to newer businesses, are now shutting the door on startups. And you might ask why? And that's because of risk aversion. To lenders, a business under 2 years old is a gamble, no matter how innovative or promising it can be. It wasn't always like this. A few years ago, entrepreneurs could secure funding in the first few months of starting their business. Today, though, these requirements leave new business owners scrambling to find alternative solutions. The message is clear. Right now, more banks want to see staying power before they're willing to extend credit to you. For newer businesses, this shift means that planning ahead is becoming more critical than ever. Building relationships with banks, even before you need the funding, might just be your secret weapon. And over the past few years, the rising rate environment has made borrowing more expensive for everyone. But small businesses are bearing the brunt of it. And here's the ripple effect. When the Federal Reserve raises rates, banks face higher costs too. To manage their risk, they tighten credit terms, demanding more proof that you're a safe bet. It's not just about how much revenue your business generates, it's about demonstrating stability. This isn't the first time rates have gone up, but we're now in the second and third years of this trend, which is when the real strain sets in. Banks are not only lending less, they're becoming pickier about who they lend to. And for entrepreneurs, that means every detail matters, from your time in business to your banking relationships, and even how you manage your accounts. The key is to play the long game. Start building your credit profile and banking relationships now. So when the opportunities open back up, you'll be first in line. And let's talk about the power of business bank ratings. Picture this, you walk into a bank ready to apply for a business credit line. The banker glances at your account, nods, and says, looks like you're in the high 5 range. We can expedite your application and assign you a dedicated representative. This is the quiet power of a strong business bank rating. A business bank rating is like a GPA for your business banking activity. It's a score that tells the bank how trustworthy you are as a financial partner. The more consistent and substantial your deposits, the higher your rating. Think of it as climbing tiers. A low 5 rating starts with $10,000 of consistent deposits, putting you in the bank's radar as a credible client. A high 5 means $100,000+ in deposits, unlocking VIP treatment, dedicated relationship managers, or BRMs for short, priority access to credit products, and even insider guidance on navigating the bank's processes. Banks love predictability. When they see steady activity in your account, they see a stable, reliable business, and that's exactly the kind of partner they want to fund. And here's the secret. Your bank account isn't just for managing cash flow, it's a tool to build credibility. To start building your business bank rating, keep your deposits untouched for about 90 days. Treat the money like it doesn't exist. The longer it sits there, the more confidence the bank has in your financial stability. And consistency is key. Even if you can't start with $10,000, regular deposits of $3,000 to $5,000 can build momentum. And then once you hit the high 5 tier, the game changes. Banks assign BRMs or relationship managers who act as your advocate within the institution. So let's say you need a credit application pushed through. Your BRM can advise you on the best timing. They can even advise you on the right utilization levels or even how much to pay down before applying. This kind of insider guidance is priceless, and it's usually tied to your bank rating. Also, if you're not quite ready to park, let's say $10,000 in your account, don't worry. There's still plenty you can do to build a relationship with your bank. You can use your business checking account as a hub for all of your transactions. Funnel Stripe payouts, wire transfers, and ACH payments into one account. This creates a paper trail of activity the bank can use to evaluate you. And then you'll want to start small, but start now. Regular deposits, even as low as $1,000, can signal stability and begin laying the groundwork for stronger relationships. They give your business bank rating as planting a seed. The effort you put in today, building deposits, maintaining activity, and keeping balances steady will grow into long-term financial credibility. And when it comes time to ask for funding, those seeds will grow into opportunities you might have thought was possible before. And I have to say this, unlike many banks, Amex deeply values your personal credit history when evaluating your business credit applications. If you've already proven yourself with a strong personal credit score and a few Amex personal cards, this can fast track your journey to securing business funding. And the Amex Business Blueprint app is a game changer for pre-qualifications. Instead of diving headfirst into an application and risking a hard inquiry, the app allows you to gauge your chances with a soft pull. For small businesses or sole proprietors looking to scale, Amex's interconnected approach can be an advantage. If you're already in their ecosystem with personal products, then pivoting to business credit feels like a natural next step. And then I got to tell you about Bank of America's secure business credit cards and secure business lines of credit. They offer an entry point even for businesses without extensive financial history. What makes them special is their ability to graduate, meaning these secure products can eventually convert to unsecured credit options, giving your business more flexibility down the road. But here's where Bank of America gets detailed. They proactively review CreditSafe and LexisNexis to assess your payment history and balances. These secondary bureaus allow Bank of America to peek into your trade line activity and payment trends and whether you're juggling too many high balances. The attention to detail might seem scary, but it's a reminder to keep your financial house in order. If you're looking to establish business credit early on, Bank of America is a solid choice. And let's talk more about LexisNexis and CreditSafe. Here's a reality check. Banks aren't just looking at your credit score anymore. They've added another layer of scrutiny by pulling reports from secondary credit bureaus. Just like LexisNexis and CreditSafe, they reveal details your traditional credit report might not, and banks are paying attention. They're looking for net 30 terms activity. These reports track how you manage payment terms with vendors such as net 30, 60, or 90-day accounts. Timely payments can work in your favor, while late payments might raise red flags. Outstanding balances. So banks now assess your unpaid balances across accounts to determine whether you're over leveraged. Even if you've managed your primary accounts well, secondary bureau data can still paint a fuller picture of your financial life. For business owners, this means one thing: everything matters. If you're not managing vendor accounts or trade lines responsibly, it could come back to haunt you during the credit application process. And gone are the days when you could just blitz through rounds of funding applications without much consequence. With the banks relying more on LexisNexis and CreditSafe, new accounts and credit inquiries are sticking around longer on these reports. And this is a problem because secondary bureau reports aren't as forgiving as traditional credit bureaus like Experian and Equifax. While inquiries on your main credit report might drop off relatively quickly, let's say after 2 years, secondary bureau data lingers longer, anywhere from 3 to 5 years. And if you're applying for multiple rounds of funding within a short window, let's say 30, 60, or 90 days, banks will see those recent accounts and inquiries on your LexisNexis and CreditSafe reports as well. This can make them hesitant to extend additional credit as it signals higher risk. This shift complicates the game for entrepreneurs who rely on strategic application rounds to secure multiple funding sources. So what worked a few years ago might no longer be effective in today's environment. And imagine finally securing a business loan and feeling proud, knowing you've taken a big step toward growing your business, but then you get blindsided later when your application for additional funding is rejected, not because of your credit score, but due to a UCC lien holding you back. A UCC lien, or a Uniform Commercial Code lien, is essentially a bank's way of staking a claim on your assets. It's a safety net for the lender, ensuring they get paid first if your business defaults. Think of it as putting a big reserve sign on your collateral, whether that's equipment, inventory, or other business assets. For the bank, it's standard procedure. For you, it's potential roadblock you didn't even realize was there. But you should know, not all loans come with UCC liens, but you'll commonly see them with SBA-backed loans and private lenders like BHG or Bankers Health Group. These institutions often lend higher amounts to higher risk borrowers, so they want added assurance that they'll be repaid. And while SBA loans are known for their favorable terms, their UCC lien requirement means they'll claim first position on your assets. This means any future lenders will take second place or none at all, making it harder to secure additional funding for you. For example, let's say you take a $50,000 SBA loan with a UCC lien on your assets. Later, when you apply for a business line of credit, the new bank may hesitate because the SBA already has a first position claim. This can limit your options for growth even if your business is booming. UCC liens can restrict your ability to secure those future funding rounds, so it's critical to approach them with a clear plan. Understand the implications before you sign those documents. Ask your lender if the loan will include a UCC lien and whether it will cover all your assets or just specific ones. And you'll want to plan for future funding rounds. If you anticipate needing additional credit, weigh the trade-offs of accepting a UCC lien versus exploring other funding options such as unsecured lines of credit. You also want a strategy to clear those UCC liens early. Once a loan is paid off, ensure the lien is released, and UCC filings don't always get updated automatically, so follow up with your lender to confirm the removal. And another thing you can't forget that's changing is increased requirements for proof of income. Banks are now requiring a longer list of documents to approve for funding, including articles of incorporation, proof your business is officially registered, tax returns, verification of revenue and expenses over the past year or so, bank statements. They want to see evidence of consistent cash flow and financial stability as well. Banks are no longer just looking at surface level metrics. They're digging deeper to ensure they're lending to a low risk business. For entrepreneurs, this means preparation is everything. And even if you have all the required documents, expect to wait. What used to be a quick approval process can now take a week or even longer as lenders comb through your proof of income documents. Businesses are just under higher amounts of scrutiny. Banks are under pressure to lend cautiously, especially in a higher interest rate environment. They're dealing with more applications with tighter funding requirements. More businesses are applying for credit, creating bottlenecks in processing. For business owners, these days can be frustrating, especially if you need funding quickly to seize an opportunity. And one business owner shared their experience applying for a line of credit. And despite having strong financials, their application was delayed for over 2 weeks because their articles of incorporation weren't updated with their current address. The fix was simple, but the delay cost them valuable time and nearly cost them a big opportunity. Another thing banks don't want you to know is there's more competition out there for your business than just the big banks and credit unions. Traditional banks love using your personal credit to guarantee your business credit with them, but times have changed. Today, there are new alternative lenders and financial technology companies where you can get fully approved for business funding without a hard credit pull and without a personal guarantee, so that you're not on the hook if your business goes under. So check out the next video to see 11 EIN only, no PG business cards. Thank you for watching.